Hello and welcome to the Camissa Asset Management Sharia presentation, our first one for 2026. And we've titled this one Beyond the Rally, Building Resilience in an Uncertain World. As many of you would know, 2025 was a fantastic year for many of us, especially for the Camissa Islamic funds, where we had substantial returns across all of our funds. And many of you have given me feedback around that. And we're pleased to report back that our funds have continued higher at the start of 2026. Unfortunately, as we know, there's been some significant geopolitical events that have marked both equity markets and as well as geopolitical markets as well. What we will do today is give you our rundown and scenario analysis of our understanding of what's been happening in global markets, and in particular how it affects both the economies as well as potential impacts on equity markets as well. Lastly, we will talk about the impact on our multi-asset class products and our capability in terms of generating alpha for our clients. As per usual, keep those pens and paper ready as we will give you some stock tips towards the end of our presentation. Our presentation is titled Building Resilience in an Uncertain World, and there's heightened uncertainty given recent events. As we know, and as you will probably watch this presentation during a live stream effective war that we've got in the Middle East, the third of the last 20 years. And in particular, what is concerning is the destabilizing effect that this has had on energy markets, both in terms of oil markets as well as the LNG market, which is actually quite a substantial market as well. So we will unpack why this matters to you, both to you and your clients. As many of you are financial advisors with a substantial client book and advisory book, it's important to understand what the impact of this will be for the remainder of this year and well into the future in our view. Secondly, we will understand and unpack the impact on the various asset classes. For some, there's actually some positive impacts as well, and we'll talk about that, most notably on the Sukuk market. And as many of you would know, our Islamic high yield has had a fantastic year last year, generating double-digit returns. And we think that that will continue in this current environment, given the outlook for yields as well. We will then talk about our alpha generating capability that spans now over 21 years, previously in our previous name under Kagiso Asset Management and now under Camissa Asset Management as well. Both our Islamic Equity Fund and our Islamic Balance Fund has celebrated significant milestones in excess of 10 and 15 years respectively of performance generation as well. So we'll give you an update in terms of how we stack up relative to the peer group and competitors in the Sharia space. And lastly, as I said, keep those pens and papers ready as we will unpack some key stock picks, especially one that we think will be a key beneficiary of the current turmoil that we see in global markets. So are you ready? Let's get into it. Clearly, events of the last couple of weeks has been noted by significant volatility in energy markets. And in particular, what we've seen is that translating into volatility for equity markets as well. When asset managers talk about volatility, it's really just a euphemism for share prices going down, markets going lower, and all the bad stuff going up, like oil prices and gas prices as well. What's been happening is that we've had, since the last 2 years with the new administration in the White House, significant geopolitical and what I would call offensive behaviors, where we've seen significant targeting of countries across the world, most notably those in Africa and the Middle East. And in this graphic that we highlight on screen now, we look at US military strikes under the Trump administration. And what is quite striking here, sorry to use the pun, is that for the last almost 18 months, we've had more activity, about 658 sort of activities, compared to 4 years of the previous Biden administration. What is also quite noticeable here, and as we'll share on the next slide, is that most of the countries targeted tend to be energy producing countries, either in terms of oil or in terms of LNG as well. And that is quite noticeable because clearly we know that the administration's mantra has been lower energy prices. But in fact, what we've seen is that the activities has resulted in substantially higher energy prices, most notably for oil and more recently for gas prices as well. Why is that the case? On the next slide, we show you the proven oil reserves. And if one looks at these 4 countries in particular that have been targeted in the last, since the start of 2026, 3 of them are significant oil producers. If one looks at Venezuela, the world's largest owner and possessor of oil reserves, over 300 billion barrels of oil. Together with Saudi Arabia and Iran, they comprise over 21 years of oil supply that could service the whole world's oil needs for the next 21 years. That is quite significant because while Saudi Arabia might not be an active participant in current events, we know that their installations have been targeted in response. And there has been some activity in Saudi Arabia as well. And in particular, what we've seen is that the Saudi Arabian oil infrastructure has been targeted as well. This is quite significant because Saudi Arabia, together with the US, are the two largest producers of oil currently in the world. And clearly, any impact on Saudi Arabia will have a destabilizing effect on oil supply. So let alone the pricing aspect of prices going higher, the actual ability to service the world in terms of oil supply could be at risk as well. And what we will unpack in the next couple of slides is really the scenarios that we've unfolded and unpacked in terms of our analysis and how that might play out for the next couple of months, if not the next year as well. The immediate impact has been on high oil and gas prices, as we highlight in the slide. And what is noticeable is that the almost vertical appreciation in the oil and gas price in the immediate aftermath. The first 3 to 4 days, we've seen oil prices up about 40% and gas prices similarly as well. The gas price that we highlight on the slide is the European spot gas price. Now, you might ask, why are we showing you the European gas price when it's a Middle Eastern issue? The real reality for Europe is that they are net importers of gas. And last year, Qatar supplied the bulk of European gas needs. And as we know, Qatar has been an unwilling participant in the recent turmoil, given that their gas infrastructure has been targeted as well. If these attacks and targeting continues, it will have a massive destabilizing impact on Europe as well, as we anticipate. So where are we currently? In terms of the summary that we've highlighted on the slide, there's quite a bit of information here, so I'll try and unpack that fairly slowly. On the top, we've got some numbers. Firstly, Iranian crude oil production. In January 2026, we were looking at about 3.1 million barrels a day. That would put Iran at number 5 in the world in terms of oil production on a daily basis. And for context, oil production and oil supply on a daily basis amounts to just over 100 million barrels. So Iran effectively supplying about 3% of the world's oil on a daily basis. And oil is a unique commodity. It's not like gold, copper, or iron ore in that it can be recycled, or it can, if you look at those commodities, they can be recycled. Even coal to an extent can be repurposed as well. Oil, once it's put in your tank and it's burned away, it never comes back. And so every day we need to replace that oil. And if there's any disruption, effectively after 25 days, the whole world will grind to a halt. And that is a staggering reality of what we're currently seeing. So the other significant development has been the geopolitical and geographical impact. So Iran is quite close to the Strait of Hormuz, and they actually control that strait as well. And currently, as at the end of February, about 20% of the world's oil and about 22% of the world's LNG pass through the Strait of Hormuz as well. We know that the Iranian Republican Guard, they've said that they will target any ships that pass through that strait that they perceive to be hostile. And already as at today's date, we have seen about 7 or 8 ships being targeted as well. So predictably, we would have seen that oil prices and gas prices, you can see the Brent price when we did this presentation was standing at about $84. I think it's been quite volatile. We have seen it breach $100 and then pulling back more recently, given talks about strategic oil reserve releases by the International Energy Agency, as well as the Department of Energy in the US as well. Lastly, the gas impact. I think for me, this is much more significant, given that the world is net short of gas, and the GCC, the Gulf cooperating countries, are the big suppliers globally of gas, most notably to Europe, as we've mentioned, but also to Asia as well. So we've seen the attack, what's happened the weekend of the February 28th, initial attacks, and the response that has ensued from that. The immediate impact has been substantially higher oil and gas prices, with LNG flows being substantially disrupted as well. Most notably from Qatar, there has been regional spillover with Iran targeting its neighbors. In particular, about 500 sites has been targeted, mainly US military installations across the region. And effectively, as a result of that, all flow of traffic across both the Suez Canal as well as the Strait of Hormuz has ground to a halt. As we stand at the end of the first week of the skirmish or this turmoil, we have seen over 150 ships being stranded with cargoes, unable to move forward or backwards as well. So in our analysis, the market outlook for oil and gas prices are key, but linked to that is effectively both the intensity as well as the duration of this conflict. And what we will unpack in the next couple of slides is really an understanding of the various scenarios under which the intensity and duration play out and what the impact of that would be on energy prices. But before we get there, let's look at Iran. Iran was the number 5 oil producer globally, about 3% of global supply on a daily basis. Iran has its primary customer being China. About 80% of their production has gone to China. We know some of that has found its way to India as well. So clearly those would be customers that would be materially affected by this latest turmoil. Iran is also a substantial LNG producer. In the slide you can see where it ranks globally, the 3rd largest producer in terms of gas, but also a substantial owner of gas as well in terms of gas reserves. And their primary gas export markets have been their neighbors, Iraq and Turkey. And we certainly believe that the Turkish economy will take a direct hit from this in terms of the energy crisis that they will see as well. So Iran is clearly a significant player in global energy markets. Also, it's quite a significant player in terms of its geographical location as well. It's important to appreciate that Iran is a vast country. Its physical size is roughly a third of the whole Europe, the entire Europe as well. So from its breadth in terms of natural resources, it's quite endowed as well. So in addition to energy, in terms of oil and gas, it does have substantial minerals. It does have base and precious metals that is available in the country. So the potential for Iran is quite significant. Under normal circumstances, we know that for the last 20 years, Iran has been subjected to sanctions. So their ability to grow the economy and to effectively develop the mining industry has been curtailed as well. On to what's happened in the last couple of weeks. So we've seen that the Strait of Hormuz, the global energy choke point, has ground to a halt, as many of the ships that have accumulated in the area have been unable to pass through the strait. At the bottom, we highlight the Asian importer dependency. So a lot of the Asian countries, China at the top, in terms of its daily demand, about 6 million barrels a day of flow coming through the strait, grinding up and landing up in China. India is second at about 1.8 million barrels a day, and even Japan being a key beneficiary of flows through the strait as well. These are critical countries in terms of both technology and in terms of AI developments, and we have seen the significant adverse impact in AI valuations that has ensued over the last couple of days and weeks as well. From a geographical point of view, there is no real credible alternative. The strait is the most efficient, easiest way to transport from the gathering systems in terms of gas and oil to the markets that it serves as well. The alternative is to go through the Suez Canal and then pass our little corner of the world, Cape Town. And unfortunately, that adds another 2 to 3 weeks of journey time and effectively doubles the cost of transportation. So economically, it's not a viable option, but clearly in times of war and times of distress, these are emergency measures, and we anticipate significant uptake of activity around the Cape of Good Hope, or Cape Town as we know it today. At the moment, and as at the 5th of March, there were around 150 ships that were stranded at that strait. They can't move forwards or backwards as well. So things are dire, and clearly in terms of the economic and political impact, also quite severe. So what we've done at Camissa Asset Management is really develop scenarios in terms of the likely extent of this current conflict. We have seen past conflicts, most notably the Russia-Ukraine situation, dragging now into its 4th year. So clearly the intensity probably less intense compared to what we've seen currently between the US and Iran. But in the scenario where you have a multi-year prolonged simmering of this conflict, it will have dire consequences for the global economy and for equity markets as well. Our base case is clearly for a 2 to 3 month duration of hostilities, and a best outcome, as we highlight in scenario 1, would be a 2-week war. Given that we're already in week 2, we would probably need to see a cessation of hostilities within the next couple of days. And by the time you watch this, hopefully that 2-week scenario has unfolded and the impact on the global economy has been limited. Under that scenario, we're looking at oil prices ranging at maximum around $95 a barrel. Bearing in mind that we've already seen oil prices breaching the $100 barrel level and now pulling back as well. That scenario increasingly seems unlikely. But secondly, in terms of the gas impact for Europe in particular, the European gas price we see potentially breaching 55 euros. That is quite significant if one looks at what happened in the aftermath of the Russia-Ukraine developments early on in the war. European gas prices peaked at about $250 euros per kilowatt hour as well. Under this scenario, clearly we would need to see a prolonged impact and European storage systems being depleted for prices to revert back to similar levels as well. What is key to understand that in the aftermath of the Russia-Ukraine situation, we have seen Qatar stepping up quite significantly and boosting European reserves of gas. Now that is important because, as we know, Qatar is now a part of this current conflict, given that their gathering and storage system has been targeted as a result of the current conflict as well. So we believe that key to scenario one would be an immediate cessation of hostilities, the Qatari LNG capability being left substantially or significantly unscarred, and clearly no significant disruption to supply from Qatar. As we've mentioned, this scenario seems unlikely given current events, and I would probably put a 10% to 15% probability on scenario one. Let's look at scenario two, which is a 2-month war. Effectively, under this scenario, you're looking at about a maximum of 60 days of duration, oil prices potentially breaching $130 a barrel, which is quite significant compared to where they were a year ago. Bearing in mind oil prices as hovered between $60 and $65, that would imply a doubling of oil prices from a year ago's levels, and also substantially inflationary impact. And we'll talk about the impact on inflation a bit later. But concomitant to that would be a rise in European gas prices, again breaching that €100 level, which is still substantially lower than the €250 level that we saw in February 2022 when the Russia-Ukraine hostilities commenced. Key to this scenario is substantial supply disruption in the order of about 20% of daily supply, between 18 to 20 million barrels a day, and an additional 4 to 5 month ramp up before you get the normal supply being restored as well. At that point, we would have seen a substantial impact on inflation, bearing in mind that for most countries, energy is a key input of the inflation basket as well. So we know that in South Africa, for example, when the oil price goes up, the taxis are quite quick to put up their prices, and that then has a feed-through impact on the rest of the economy as well. What is also quite significant, I can't remember of any taxi reducing fares, so clearly we are unlikely to see a substantial reduction in fares and especially imported inflation, even in an eventuality where oil prices retreat back to the $60 to $65 level. So this is quite important for the global economy and has massive implications for South Africa as well. Lastly, I don't even want to talk about scenario 3. That is probably the worst case outcome, where you have a 1-year war with substantial intensity as well, so maximum of 12 months. Under that scenario, we could see the Brent oil price reaching uncharted levels. The previous peak for oil prices was just below the $200 barrel level. We could see $200 a barrel oil before this 1-year period is out. Additionally, European gas prices will probably breach the €100 level as well, and potentially reach that €200 to €250 level, depending on the nature of the conflict and how it drags on as well. Again, a full supply disruption of about 20% of global daily supply of oil, and a concomitant increase in activity and disruption of gas supply as well. Most notably, what we will see is that under that scenario, substantial countries being especially the emerging market countries that are oil dependent and dependent on oil imports, having to ration oil supply. And that then have a feed-through impact on the rest of the economy as well. If you think about when we had load shedding and the energy crisis with Eskom, I think an energy crisis in terms of oil would be on a similar, if not greater, impact and magnitude for the South African economy as well. So why is this important? Because as we've mentioned, there's a direct impact in terms of inflation, but then there's also the indirect and simultaneous impact on economy, on energy levels and production levels within our country as well. So to summarize, in terms of our analysis, we've done a quantitative analysis and the various scenarios. On the left-hand side of the slide, we look at the Brent crude oil price. Pre the conflict, we were looking at about $65 to $67 oil, and we can see that the oil price ramps up the longer the war drags out. Under scenario 3, we're looking at the midpoint of about $175, which is almost a 3-fold increase in the oil price from its pre-conflict levels as well. And then on the right-hand side, the natural gas impact. So prior to these hostilities commencing, in February this year, the European gas price was sitting at about €30. So we can see under scenario 3, almost a 4-fold increase in that level of pricing. And that then also having a direct impact on inflation in Europe, most notably countries like Germany and France as well. So the bottom table, just for your convenience, gives you the various scenarios and the pricing outcomes that we've discussed. Again, I would highlight the fact that especially on a one-year scenario, we will probably gravitate towards the top end of the range, $200 potentially for Brent oil, and about 100 euros for the European gas price as well. Again, these are probably fatalistic scenarios, and we would probably gravitate towards scenario 2, which is a 2-month war, and hopefully sanity prevails and the world order is restored in quick succession as well. Already we've seen the impact on equity markets with a substantial drawdown in equity prices, both in the US and Asia as well. And the rhetoric coming out of both the White House and other regions is for stability to be restored to markets. So we would hope that the two-month scenario is the one that prevails, and that we see limited impact in terms of both oil and gas infrastructure, in terms of the direct impact for those countries as well. Why is this important for you as a financial advisor or for your clients? Because in addition to the direct inflation and economic impact, there are the broader market and geopolitical implications as well. For China, South Africa being a key trading partner with China, they are the most exposed buyer. About 80% of China's energy needs flows through the Strait of Hormuz, and clearly any disruption there will have a direct impact on the Chinese GDP as well as the inflation numbers as well. So China's ability to then produce and then export product would be compromised under both scenario 2 and scenario 3 as well. Russia potentially the only real beneficiary out of all of this. So we note that the White House has allowed India to resume imports of Russian crude oil. So clearly Russia stands to benefit from a prolonged disruption. Prior to the war in Ukraine, Russia produced about 13 million barrels a day of oil, roughly about 13% of global supply. And so Russia is a key player. Most of that oil has been under sanctions for the last couple of years, given the activities in Ukraine. But under scenario where Russia is allowed to, under emergency conditions, I suppose, be allowed to export oil, it does have a dampening effect on rising prices as well. But Russia would clearly benefit from that scenario as well. The US has talked about release of the strategic oil reserves. Unfortunately, those oil reserves are fairly limited. We know that the US has about 30 days of supply of oil, and clearly that would be mainly for their own domestic needs. The US is also a large consumer of oil as well, so there would be limited impact for the rest of the world from that strategic oil release in the US as well. It's really all about LNG and Qatar. As we've mentioned, Qatar is the world's biggest producer and supplier of LNG, especially to Europe. And under a scenario where the biggest complex, which is called Ras Laffan, is compromised, it will have devastating impacts for countries that are major importers of LNG from Qatar, most notably Europe as well as Asian countries as well. And concomitant to that is the global recession risk. And in particular, what we could see a scenario where we've got rising inflation with lower economic growth, a concept called stagflation. And I think under scenario 2 and 3, especially scenario 3, the global recession risk just increases commensurately as well. On shipping and insurance, we know that a lot of the big shipping insurance companies have announced that they've waived and they've pulled their war insurance because clearly under war conditions this can be quite costly. Again, companies might be unwilling to traverse the Strait of Hormuz if there's no insurance available for them as well. So the bottom line is that the duration of the conflict is the single most important variable here. Under our 3 scenarios, it's really the flexing of the duration of the conflict that impacts both prices in terms of oil and gas prices, but also the concomitant impact on the broader global economy and inflation as well. So as we've highlighted, our 2-month scenario, scenario 2, is probably the most optimistic, but also the best case outcome for us at this stage. I think we've already breached scenario 1, given that we've got limited time for the 2-week scenario to play out. But consequently, a 1-year scenario, I think, is quite devastating and would be quite detrimental for the global economy as well. We do think that you should position your clients and your portfolios for potential of a bit of scenario 2, but probably gravitating towards scenario 3, because clearly planning for the worst and hoping for the best would be a viable sort of outcome under these circumstances as well. So what are the market implications of all of this, and why have we spent so much time talking about oil and gas prices? Clearly, our focus at Camissa Asset Management is on bottom-up research and looking at bottom-up earnings for corporates as well. But clearly, where we've got key drivers like oil and gas for certain sectors of the economy, it does have implications for future cash flows for markets as well. In the wake of 2025, where we saw quite a significant appreciation in equity market prices, where our own market rose well beyond 60% in 2025, we are now in the realm that after a very strong start to the year, we are in a period of heightened volatility and much lower share prices as well. So after the 2025 record year for risk assets, the fog of war is permeating global markets, and we have seen the impact of that. Most notably, both in Europe, Asia, and the rest of the world, governments are scrambling to increase defense spending, and we have seen a rising increase in global debt levels in terms of governments funding greater military spend. In Europe, most European countries have doubled their military spending from about 2.5% of GDP to an order of 4 to 5% of GDP as well. Unfortunately, the bulk of that has been funded with debt. In a scenario where we see rising inflation, there will be a concomitant rising in interest rates and yields as well. So the cost of debt will become much more expensive as well. Unfortunately, wars tend to create uncertainty and sap consumer confidence. As we know, most European and developed markets, the engine room for those economies are consumer spending and consumer confidence. And the scenarios that we've seen previously for Europe with the Russia-Ukraine situation, consumer confidence has significantly declined in most of the European areas, and we've seen the impact of that with both Europe in terms of its GDP, France and Germany seeing both recessions in the immediate wake of the Russia-Ukraine situation, but also prolonged and protracted, slow and retracted economic growth as well. Energy choke points tend to be immediate. And we spoke previously about 21 to 22 days of global supply. Under scenarios where we see a disruption, quite a severe disruption to the flow of energy, it will spur short-term inflation as well. Clearly, we are in the realm then of rationing of energy as well, and the impact of inflation would be quite substantial. Normally, under economic conditions where we've got lower growth, we also see a moderation in inflation because demand drops off. But where we've got a cost push inflation like we would see under energy prices going up, you have the specter and scenario of stagflation coming through, and that duration of this conflict will determine the extent and severity of that stagflationary environment as well. So it's quite important that we understand the likely impact on equity markets, the broader economy, and clearly for clients and investment portfolios as well. In summary, we're talking about high inflation, lower growth, and the impact of that will have quite negatively in terms of both corporate earnings and cash flows as well, especially for the first 12 to 18 months as well. I think the one silver lining for Sharia investors and potentially bond investors is that you'll see a rise in bond yields and sukuk yields, clearly to combat the impacts of short-term inflation, but to the extent that you can lock in higher rates, that would be beneficial for investors, especially those close to retirement as well. The next slide looks quite busy. It's really a timeline going back to 1900, which is 125 years of history. And it just highlights the various conflicts that we've seen globally. What is important to note here is that whenever there has been conflict, it's invariably followed market volatility. Most notably prior to World War II, where we had the global depression, the 1973 war in the Middle East as well was followed by heightened volatility around oil prices, and that also spurred a global recession as well. So we think that under scenario two, you might find a repeat of the 1973 oil crisis, where oil prices spiked, we had a global recession, and clearly, devastating impact on equity and economies as well. The Gaza war of last year stands out as one with heightened political risk. It does the red line, the GPR, which is geopolitical risk that we highlight in the slide. And we think that the current turmoil is not even registering yet. I think this was done before the recent events of the beginning of March, but it will probably rank close to 9/11 in terms of its magnitude on this chart as well. Most countries have scrambled to increase military and defense spending, and we've seen a concomitant rise in government debt levels to the tune now where global debt levels so this slide looking at only global debt on a government level basis, now breaching $350 trillion. That's a staggering amount, and one can see in the last year about 10 trillion has been added to the stock of global debt to fund the increased military spending. As a percentage of GDP, read on the right-hand side of this graph, that now breaches 300%. So 300% debt compared to the GDP of these countries as a collective. Again, a staggering number, and what will make this worse is in the scenario of heightened inflation and rising inflation, as bond yields go up commensurately, the cost of debt will also increase as well. So in conclusion, in terms of this segment, what are the investment implications for markets and for companies as well? At the top, we highlight from a sectoral point of view the beneficiaries and the likely winners out of this. The obvious ones would be the integrated oil majors, especially those that are not exposed to what's happening in the Gulf. So these would be US oil producers that are domestically focused. Some of the global multinational oil companies, the likes of Shell and BP, they do have exposure to OPEC or the GCC countries, but they have diversified portfolios, so they would at the margin also be beneficiaries as well. The US clearly a key beneficiary in terms of its ability to produce shale and then to export LNG from the US as well. Russia, as we've mentioned, as a large oil producer, stands to benefit with the lifting of sanctions. And then any company involved in energy infrastructure, so pipelines. As we know, a lot of the pipeline storage facilities have been targeted, so there would be a rebuilding required. But also existing energy infrastructure will benefit from rising capacity utilization as well. And in particular, that links to our later talk around stock picks, where we will highlight one of the stocks that we have in our global Sharia portfolio that stands to benefit from this theme around energy infrastructure as well. On the negative side, oil-intensive manufacturers. So these would be the mining companies, any company that uses a lot of energy for either transportation. If one looks at airlines, shipping companies, the chemical companies, Iran is a substantial producer of chemicals as well, and the ability to export chemicals are clearly compromised. So we have seen chemical prices also increasing quite dramatically. Emerging market oil importers, South Africa, we are a net importer of oil, so we stand to lose from having to pay a lot more for energy, and clearly there would be the inflationary impacts as well. Lastly, global growth and cyclical companies. As we see a downturn in the economic cycle, cyclically sensitive companies would clearly be losing out in terms of the ability to generate revenues and also a shrinking in profit margins that we would likely to see, especially under scenario 2 and 3 as well. So what are we doing about events of the last couple of weeks in markets for your portfolios? I think what is important to recognize is that COMISA's alpha generating equity capability remains sound and intact. And given our bottom-up approach, we actually are well positioned to unearth opportunities, as we've highlighted in terms of energy infrastructure, but also avoid those sectors and companies that might be detractors and losers in terms of the current energy construct. In particular, those companies where cash flows might be compromised for the next couple of years as well. Our proven equity approach, which is valuation orientated, somewhat contrarian, so we will look for opportunities where others might not be looking for. In particular, our focus on cash flows where the economic reality bites. And that is quite important because for most companies, when you have an economic cycle that is masked by rising equity prices, rising energy prices, the cash flows are not really that visible or clear in terms of the real economic impact. And we believe by focusing on those key drivers, dissecting those key drivers, and then linking it back to the cash flow generated by the corporates, it's important to understand what the real impact of those key drivers would be for those corporates as well. Last, it's important to look beyond the next year. So even in the severity of scenario 3, where we look at a 12-month disruption, it's important to look beyond that. And sometimes energy and share prices discount the worst outcome. We have seen in the immediate aftermath about a 20 to 25% reduction in certain sectors of our market, most notably the mining companies. And if one had to normalize for current conditions, there might be opportunity in those sectors as well. And the bulk of the value typically for these companies are generated on what we call the terminal value. So the short-term cash flows might take a hit, but the medium to long-term cash flows and terminal value might remain intact as well. What we try and do is not have a knee-jerk reaction. So try and exploit where crowded sentiment hovers. So typically what you'll find is that there's been a massive crowded trade in AI. Most of the AI stocks in Asia and the US has seen substantial increases in share prices in 2025. And lo and behold, in the first week of March, many of those share prices has declined by between 25 to 30%. So from optimism to pessimism. So where there's extreme pessimism, that typically gives us opportunity as well. And last, it's important to take emotion out of the investing equation. So we invest with discipline, no matter how lonely or uncomfortable it might be. And sure, in the short term, we might look like foolish, and especially if we are wrong in terms of share prices in the first 2 to 3 months. But medium to long term, as many of you would know, our long-term track record and performance signature bears testimony that this approach and valuation approach certainly works and has delivered substantial results for you as clients as well. It's important that whilst we have sketched three scenarios, we are humble enough to say that things could evolve very differently compared to what we've sketched here. And we should have the openness to change our minds as things unfold. This is an evolving crisis and turmoil, so the facts on the ground might change the longer it drags on as well. I think what is critical for us and what has been key to our success over the last 15 years, especially for Shariah clients, has been taking a high active share positioning with conviction. So where we have high conviction in the cash flow impacts in terms of valuation, we are not afraid to have outsized positions in the portfolio relative to benchmark. And we'll share some slides to you later in terms of how that has played out over the last 10 to 15 years as well. So our equity approach in terms of the key inputs, we've seen cash flow modeling with the scenarios that we've unfolded and sketched for you. And really key to that is the likely scenario 2 and 3, both in terms of the short-term impact on cash flows, but then also the medium to long-term impact on valuation as well. As we've mentioned, it's marrying up the sentiment aspect where share prices, especially in the mining sector, has seen a significant retreat compared to the likely impact on the cash flows of those companies. What we mean by that is that we might see a limited impact in terms of cash flows for the mining sector, but the share prices already discount multiples in terms of those cash flow impacts as well. And by focusing on long-term prospects for these mining companies, we would then be able to exploit the divergence between negative sentiment or bearish positioning versus the likely negative short-term impact in terms of cash flows, but the longer-term fundamentals remaining intact as well. And it's really doing this with discipline, so taking the emotion out of the equation as well. If one then looks at our relative positioning from an active share point of view, what the slide highlights on the percentages on the vertical axis is a percentage of active share. And we've compared our active share with some of our Shariah competitors in the South African market. And what we highlight in the range there is really the positioning of most of the Shariah managers between roughly 25 to at most 55% in terms of active share. So what you then have is that if you blend any of them together, you get a very similar outcome. You effectively getting closer to a passive fund. Our active share substantially above that, as highlighted by the red line, will mean that by blending us with any of the other Shariah managers, you're getting a much better outcome in terms of active share. And certainly the theory suggests that with high active share comes a higher ability to generate alpha for clients as well. And certainly in South Africa, the South African market has delivered substantial long-term real returns. The blue bars effectively highlight nominal returns, where the average has been around 10%. And then the real return adjusted for inflation, as per the gray bars, we've seen a real return of about 6% in South Africa. So for us, that is a clear target, both in terms of our high yield fund, as well as our balanced and equity funds as well. So the next couple of slides will highlight our fund positioning relative to peers. Firstly, in terms of the 1-year numbers, 3 years, 5 years, and then since inception. I will mainly focus on the 1-year numbers, as many of you are aware of our longer term track record as well. So as we've mentioned, we've had a very good year in 2025. You can see the peer group average delivered about under 25% returns in 2025. And our fund, we've seen about a 3 to 4% outperformance, delivering about 28.5% return from our Islamic equity fund. In terms of the Islamic Global Equity Fund, again, a very good year. What is quite ironic is that the rand appreciated quite substantially in 2025. So dollar returns were in the magnitude of about 40% last year. But because of the rand strength, we've seen a 17.9% return for our Islamic Global Equity Feeder Fund, still well ahead of peers that has delivered around 11% in 2025. And you can see that has also followed through to the 2-year numbers as well. Now switching to our multi-asset and yield capability. As we've discussed, certainly for multi-asset investors, most notably pension fund, retirement fund, living annuity clients, multi-asset capability and positioning is key to long-term real return generation as well. And what we highlight here is our Islamic Balance Fund asset allocation. Most notably here is a substantial allocation to Sukuks. In the South African construct, we've got two primary issuances of Sukuk, the government Sukuk that is available. It's a leasing or ijara model that we have. That is quite a big slug of our Sukuk portfolio. And then alongside that are the bank-issued Sukuks as well. So banks' ability to issue Sukuk in South Africa is almost unlimited. When we interact with the banks, they will create Sukuks for us. What is key there is to match the return versus the yield, the return yield on the one hand versus the duration. So for us in a rising Sukuk yield environment, we want to keep low duration, so keep it below 1 year to benefit from rising rates and higher yields in the future. And that is effectively the strategy we've deployed in both our Islamic Balance Fund as well as our High Yield Fund. So with rising yields on the back of potentially high inflation rates, we will see both Sukuk yields and government bond yields rising. And we are keeping some powder dry in terms of our ability to then deploy funds with rising yields coming through, especially in the Sukuk market. So that's the strategy on the Sukuk market. I've got a slide later that will highlight that more visually and the impact that we see on the Sukuk market with rising inflation as well. What we've also done in terms of our Islamic Balance Fund is increase our offshore global equity allocation. So as many of you would know, last year we finished the year at roughly about 29% in global equities. We have increased that to benefit from the fairly strong rand. Most of that was taken over below 16 rand to the dollar. And we have seen the rand weaken in the aftermath of the recent turmoil in the Gulf area. So already we've seen a benefit from increasing our offshore allocation. And to fund that, in terms of SA equities, we've reduced SA equities, especially on the mining side, where we've taken some profit on some of the PGM names that have done particularly well last year, as well as reduce our exposure to stocks like MTN that has doubled in about 18 months in terms of its share price as well. As we've mentioned, yield asset strategy is quite important for the next 12 to 18 months. Because in a rising inflation environment, we are likely to see both bond yields and Sukuk yields go up materially. This is a busy slide, so I'll take a moment to explain it. Firstly, if one looks at the light blue band, there is a fair value range for both Sukuks and government bonds. And all those numbers that you see on screen, the R2032, the R209, those are actual bonds in terms of the red dots. And then the yellow triangles, those are the Sukuks. What is quite noticeable are that for each year, if one looks at the horizontal axis, if one looks at the 5 to 7 year category, for example, some of those Sukuks are giving better returns compared to the government bonds. The reason for that, we believe, is partly because there's been very little liquidity in some of the government Sukuk, and so returns are higher compared to government bonds. But also we believe that Sukuks are a more attractive asset class, given that it is asset-backed. In terms of its ijara construct compared to the unasset-backed government bonds that we have in South Africa as well. We've highlighted the grey line on the top. So the grey line represents the yield curve as at 30th of April 2024. Why is that important? As you'll remember, we had our elections around that time, and that was just before the Government of National Unity was formed. There were quite a lot of concerns around political violence potentially in the aftermath of the elections, and that was priced into the bond market. Lo and behold, we had quite a decent outcome in terms of the elections and the GNU being formed, so that yield curve has actually shifted lower. So from that the grey line, we have seen the yield curve shift to the blue line. So if one take, for example, the 19-year period, the 2044 government bond, it previously yielded about in excess of 12% 2 years ago. It's now yielding about just over 8%. So that shifting lower in terms of the yield curve means that there has been substantial capital gains and capital growth from the government bond market and concomitantly from the Sukuk market, the government Sukuk market in South Africa as well. More importantly, we believe that if the Reserve Bank is successful in getting the inflation band between 3 to 3.5%, the bond market is still offering substantial real returns. And whilst we've taken profit on the longer end, we think that the shorter end of the yield curve is still fairly attractive on an inflation-adjusted basis as well. Turning to the Islamic Balance Fund in terms of its relative positioning, we have seen again a very strong year last year in terms of 2025, just over 20% return for our Islamic Balance Fund, outperforming the peer group average that returns just over 15%, as you can see there. Again, key to our Islamic Balance Fund performance has been both the global equity performance that I've mentioned earlier, as well as SA equity performance, most notably from the likes of MTN and also the mining sector as well. The high yield fund, now over 5 years old, again, stellar performance across all periods. The 1 year numbers, one of the few income funds that have delivered both a double-digit return and in excess of 14%, as you can see there. And well ahead of the Sharia peer group as well. So most of the Sharia peers delivering below 10% in terms of the 1 year numbers. And then also over 2 years, 3 years, and since inception, you can see well ahead of peer group in terms of the high yield fund performance as well. So hopefully you've gotten a flavor of our equity positioning, our thoughts on the market, and then in particular how we stack up relative to peers, both in terms of our equity performances as well as our multi-asset capability. Now we're on to the last segment of our presentation, where we unpack key equity positions, and hopefully you've got your pens and papers ready. So this company, we pronounce it Zoetis. It's actually quite an interesting company. It was spun out of Pfizer. So Pfizer, a global pharmaceutical business, disposed and spun out Zoetis in 2013. And 2013 was quite a marked year for Zoetis because they also commenced with a substantial acquisition in that year, and that transformed the business into the global leader in animal health. What do? They are the global pure play animal health company focused on animal nutrition and concomitant medication, mainly for veterinaries and for surgery applications as well. In terms of their portfolio, they both have companion animals, so your dogs and cats, as well as livestock in terms of their product range. That is quite important because they tend to be counter-cyclical. So the livestock area could be cyclical in terms of, as we know, there's an agricultural cycle, whereas companion animals, there's no real cycle. I mean, you will love your dog or your cat, irrespective of what the economy is doing. So that's quite important because they generate revenues across both the cyclical and non-cyclical components of their portfolio. But more importantly, tapping into recurring and growing demand, especially in terms of domesticated animals as well, which is a global trend. Is not just in Western economies where we've seen with rising age limits and people living longer, the incidences of people living alone, being quite lonely, especially in Asia. That's a key market, and we have seen the rise in demand for companion animals, from your cats and dogs to goldfish, for example. The other key point to Zoetis is its pricing resilience, its ability to price its products, given that they're a clear leader globally, but also that resulting in higher margins and very strong cash flows for the business. As you know, our process is around cash flow generation, analyzing the cash flows, and building our DCF models based on that as well. They've seen strong innovation, especially post the separation from Pfizer, where they've launched quite a few new products. There's quite a strong and healthy pipeline of new products as well that they're currently working on. And that's because of a substantial allocation to R&D as part of the expense line as well. They also have their own direct sales force. So they've got sales agents and sales reps that are traversing the world across various countries to deepen relationships with vets and with animal surgeries as well. So in addition to your nutrition that you can buy from your local pharmacy or grocery store, most vets and surgical places for animals actually stock their products as well. On the left-hand side, just some examples of the products that they produce. Over 300 products that they sell, as we spoke about, companion animals, as well as livestock, cattle as well. Across all of those categories, they are the number one. And then geographically, North America, Latin America, and Asia, they dominate those markets. Asia in particular, as we've mentioned, Japan being a key growth market for them, given the aging population in Japan as well. On the right-hand side, you can see the revenue split by species. Dogs and cats, your domesticated animals, roughly about 65% of the portfolio, and that is the bulletproof part of the portfolio. We've seen consistent rising in terms of both volumes and pricing, and that being the bedrock of cash flows for Zoetis. On the right-hand side of the pie chart, you can see livestock forming about 9% of the portfolio, a bit more cyclical, but also growing over the long term as well. Clearly, the economic power of human-animal bonds is very strong. Most of you probably have a cat or a dog, so you will know what I'm talking about. And clearly with human-animal bonds reaching levels in excess of 90%, I mean, most people consider their pet as part of, as another family member, and they will spend quite significantly on their pets as well. And we have seen, I mean, clearly in terms of animal nutrition, that has been a key area. I mean, notably in South Africa, we've seen the retailers catching on and cottoning on to this. The likes of Shoprite and Checkers even starting pet divisions or pet shops as well as a result of that. I think the other almost counter-cyclical thing about spending on your pet is that that's probably the last thing that you'll cut in your budget as well. It will form part of your food budget, I think. So clearly for many people, that is the most resilient part of the spending, irrespective of what happens in terms of the economy as well. Zoetis was spun out of Pfizer in 2013, and you can see it's actually outperformed Pfizer over that period. Pfizer has been a bit more cyclical in terms of its revenue generation, whereas Zoetis has continued to grind high in terms of its revenue growth as well. And we see continuation of that in terms of the strong growth in high return signature. On the right-hand side, you can see the return on invested capital breaching almost 30% last year. And similarly, the EPS growth rates also being quite substantial. Even during the COVID pandemic era, we haven't seen this company going down in terms of its earnings. And that's because people, almost like food, we've seen continued spending in terms of animal health and animal nutrition as well. So Zoetis is a key part of our Sharia Global Fund. And one of those stocks that we think, whilst the share price has come down, it's down about 20% over the last 12 months or so, we think there's a compelling investment case. It's about a $50 billion market cap company trading on around 17 times earnings, which we think is quite conservative given the earnings ability and capability of Zoetis to generate cash flows as well. The last stock I want to talk about is a company called Gas Transport, or GTT as we call it. This is a French company that was started in the 1960s. We call it the invisible monopolist, and you'll see why we call it that. The company was started in 1960, and globally it has over 90%, actually 95% market share of the global LNG market. Now, we spoke about LNG and the impact that the current disruptions will have. Now, we know that a lot of the infrastructure has already been damaged. So what GTT does, it develops, maintains, and sells proprietary containment systems for LNG. What does that mean? Effectively, gas, as we know, natural gas is quite a volatile sort of product. You can't just easily transport it or capture it or put it in a pipeline or a tank. You need a mechanism or some device to contain it. And GTT has developed what they call membrane containment systems that needs to be put in a pipeline or in a tank that enables both the producers of gas to use and to both gather and effectively transport LNG. So LNG is effectively the liquefaction of natural gas. As part of that liquefaction process, you need these membrane containment systems in the pipeline and in the storage tank to make sure that the gas doesn't become more volatile, especially as it is transported as well. Given that this company was started in the 1960s, one would have expected there to be significant technological advances in this area. But lo and behold, there is no single credible alternative or competitor to GTT because the technology works. And already they've made advances into fuel cells as well. But the bread and butter of this business is LNG. And we know that the LNG market has grown substantially over the last 4 years, out of the US in particular, where the US has become a large net exporter of LNG. So GTT has benefited from the growth in LNG in the US. And more importantly and more significantly, for the next few years, we see continuation of that. So about 84 million tons of new LNG capacity coming on stream as countries are scrambling to secure energy sources as well, both in terms of gathering systems, but also in terms of pipelines as well. And given that GTT has relationships with the dominant shipyards in Korea and China, so Korea and China dominate shipbuilding and tanker building globally. They've got almost 97% global market share. For GTT, it's important to tap into those markets and be a key supplier to those shipyards and then effectively feed off their growth as well. Currently, and as per the 2025 financial results, the order book is standing at just under 2 billion euros. So they've got visibility for the next 4 to 5 years. In fact, till 2031 in terms of orders. Given that there are long lead times in terms of building ships and building container systems, it's important for them to sign up the client before the ships and before the tanks are actually built. And that gives them visibility and almost reliability in terms of saying, we know for the next 5 to 6 years what our earnings and cash flow will look like as well. So we believe that on the left-hand side, you can see the LNG supply and demand balance, a substantial increase that has come through from that 2022 to 2024 period. But then more importantly, from a demand growth point of view, the red line continuing higher for the next 4 to 5 years. And in fact, beyond 2040, we see continued growth in demand for LNG. And clearly, given the current construct of supply, ships, tanks under construction, there will actually be a shortage when we get to 2035 to 2040 levels. So we see continued demand for GTT in terms of the order book. And on the right-hand side, you can see some of the orders that they've already received. So the order book stretching out to 2034 already in terms of LNG carriers and in terms of very large crude carriers, combined, you're looking at over 500 units. So a unique company with a unique technology, but also predictability, certainty of demand and certainty of revenues for the next 5 to 10 years in an environment where we see heightened uncertainty in global markets as well. So in conclusion, you have absorbed a lot today. Just a reminder of the various fund platforms that our funds are available. You can see the list platforms that we are available on. Speak to your financial advisor or approach the various platforms if you would like to get more information on our products, especially our high yield fund that is ideally placed for living annuities, retirement funds, and pension and retirement fund products. Our concluding thoughts for today. 2025 was an exceptional year for South African global investors, as we've highlighted. Most notably for equity investors, but across all asset classes. We've seen a very strong end to the year in December last year, and then a very strong start to the year in January. Unfortunately, things have started to unravel at the end of February and going into March this year. The fog of war creates heightened economic uncertainty, and we have seen heightened volatility in energy markets. The specter of rising inflation, lower economic growth, permeates markets currently. So we believe that 2026 will be a much tougher year for equity returns compared to 2025. And it's important to prepare and position our clients for this as well. A prolonged conflict, especially post 2 months, will have dire consequences on the global economy. And it's important that we position, prepare for this and position client portfolios accordingly as well. More importantly, for you as Camissa Asset Management investors, we have identified key winners and losers out of this. And in particular, the winners, we think companies like GTT that we've just spoken about will be key beneficiaries from the current turmoil that are likely to reverberate into equity markets well beyond the current year. So our portfolios are positioned for resilience, and we think that we are positioned for outperformance irrespective of the outcome of the current conflict and the likely fallout, both in terms of economic inflation as well as GDP growth as well. Thank you for your time, and have a good day.